Is TSLY ETF the right investment for you? Welcome back, investors. Today, we're diving deep into the Technology Select Sector SPDR Fund, TSLY ETF, to uncover its investment thesis, selection criteria, sectoral allocation, and more. If you're considering investing in TSLY or simply curious about its strategies, this video is for you. Let's explore the ins and outs of TSLY to help you make informed investment decisions. Question 1. What is the underlying investment thesis of the TSLY ETF? In today's dynamic financial landscape, exchange-traded funds (ETFs) have emerged as a popular investment vehicle for both individual and institutional investors seeking diversified exposure to various asset classes. Among the myriad of ETFs available in the market, the TSLY ETF stands out as a compelling option, drawing attention with its unique investment thesis. In this comprehensive analysis, we delve into the underlying investment thesis of the TSLY ETF, exploring its core principles, strategies, and objectives. At the heart of every successful investment strategy lies a clear and coherent investment thesis. For the TSLY ETF, this thesis serves as the guiding principle that shapes its portfolio construction, asset allocation, and overall investment approach. So, what exactly is the underlying investment thesis of the TSLY ETF? The TSLY ETF, short for Technology Select Sector SPDR Fund, is designed to provide investors with exposure to a carefully curated selection of technology sector companies. Its investment thesis revolves around harnessing the transformative power of technology to drive long-term growth and capitalize on emerging trends within the sector. Key components of the investment thesis. 1. Technology sector focus. Central to the investment thesis of the TSLY ETF is its laser focus on the technology sector. This sector encompasses a broad spectrum of industries, including software, hardware, semiconductors, telecommunications, and internet services. By concentrating its investments within this high-growth sector, the TSLY ETF aims to capitalize on the innovation, disruption, and rapid technological advancements that characterize the industry. 2. Innovation and disruption. Within the technology sector, innovation and disruption are constant drivers of change. The TSLY ETF recognizes this dynamic landscape and seeks to invest in companies at the forefront of innovation. These companies are often pioneers in their respective fields, developing groundbreaking technologies, products, and services that reshape industries and redefine the way we live, work, and communicate. 3. Long-term growth potential. Another fundamental aspect of the TSLY ETF's investment thesis is its unwavering focus on long-term growth. While short-term market fluctuations and volatility may occur, the TSLY ETF maintains a steadfast commitment to identifying and investing in companies with sustainable growth prospects. By adopting a long-term investment horizon, the TSLY ETF aims to capture the compounding effects of growth over time and deliver attractive returns to investors. 4. Risk management. Despite the allure of high growth potential, the technology sector is not without its risks. The TSLY ETF recognizes the importance of prudent risk management and employs various strategies to mitigate risks within its portfolio. These may include diversification across subsectors, company sizes, and geographic regions, as well as rigorous due diligence and ongoing monitoring of portfolio holdings. The TSLY ETF offers investors a compelling opportunity to gain exposure to the transformative power of technology through a well-defined investment thesis. By focusing on the technology sector, embracing innovation and disruption, prioritizing long-term growth, and effectively managing risks, the TSLY ETF seeks to deliver value to investors seeking exposure to this dynamic and rapidly evolving industry. As with any investment, prospective investors should conduct thorough due diligence, assess their risk tolerance, and consider their investment objectives before making any investment decisions. Question 2. How does TSLY select its constituent companies, and what criteria are used for inclusion? At the core of TSLY's investment strategy lies a rigorous company selection process aimed at identifying and including companies that align with its investment objectives and provide exposure to the burgeoning technology sector. This process encompasses a comprehensive evaluation of various factors and criteria, ensuring that only the most promising and influential companies find their place within the TSLY portfolio. Key criteria for inclusion. 1. Market capitalization. TSLY employs a market capitalization-based approach to select its constituent companies. Companies considered for inclusion typically exhibit a sizable market capitalization, reflecting their significance and prominence within the technology sector. This criterion helps TSLY focus on established industry leaders with the financial strength and stability to weather market fluctuations and capitalize on growth opportunities. 2. Revenue and earnings growth. Another crucial criterion utilized by TSLY is the assessment of revenue and earnings growth potential. Companies demonstrating robust revenue and earnings growth prospects are favored for inclusion in the portfolio, as they signal the ability to generate sustainable long-term returns for investors. TSLY's emphasis on growth-oriented companies underscores its commitment to capturing the upside potential of the technology sector. 3. Innovation and disruption. TSLY places a premium on innovation and disruption when selecting constituent companies. Companies at the forefront of technological innovation, pioneering groundbreaking products, services, or business models, are highly sought after for inclusion. By investing in innovative companies, TSLY aims to capitalize on emerging trends and disruptive technologies that have the potential to reshape industries and drive long-term growth. 4. Industry leadership. Industry leadership is a key determinant in TSLY's company selection process. Companies that occupy dominant positions within their respective subsectors or exhibit strong competitive advantages are given preference. TSLY seeks to invest in companies with a proven track record of success, robust business models, and sustainable competitive moats, positioning them for continued growth and market outperformance. 5. Financial health and stability. The financial health and stability of prospective constituent companies are carefully evaluated by TSLY. Factors such as balance sheet strength, cash flow generation, and debt levels are scrutinized to assess a company's resilience and ability to navigate challenging market conditions. TSLY prioritizes companies with solid financial fundamentals, mitigating the risk of investing in financially distressed entities. 6. Geographic diversification. TSLY also considers geographic diversification when selecting constituent companies. While the majority of its holdings may be concentrated in the United States, TSLY seeks to diversify its exposure by including companies from other regions, such as Europe and Asia. This geographic diversification helps mitigate country-specific risks and provides investors with broader exposure to global technology trends. The company selection process employed by the TSLY ETF is a meticulous and multifaceted endeavor aimed at identifying and including companies that embody the essence of the technology sector. By leveraging a combination of criteria, including market capitalization, revenue and earnings growth, innovation and disruption, industry leadership, financial health, and geographic diversification, TSLY strives to construct a portfolio that reflects the dynamic nature of the technology sector while delivering long-term value to investors. As investors navigate the complex landscape of ETF investing, understanding the criteria for inclusion in TSLY's portfolio can serve as a valuable guide for informed decision-making and portfolio construction. Question 3. What sectoral allocation does TSLY primarily focus on, and what is the rationale behind this allocation? Sectoral allocation refers to the distribution of investments across different sectors or industries within the economy. It is a crucial aspect of portfolio management, as it determines the exposure of an investment vehicle to various sectors and influences its risk-return profile. For the TSLY ETF, sectoral allocation is a strategic decision that reflects its investment objectives, market outlook, and risk management considerations. The TSLY ETF primarily focuses on sectors within the technology industry, which encompasses a wide range of subsectors, including software, hardware, semiconductors, telecommunications, and Internet services. Within this overarching theme of technology, TSLY allocates its investments across specific subsectors based on their growth potential, market dynamics, and alignment with its investment thesis. Rationale behind sectoral allocation. 1. Growth potential. The primary rationale behind TSLY's sectoral allocation to technology is the sector's exceptional growth potential. Technology companies are at the forefront of innovation and disruption, driving advancements in various fields and reshaping industries. By focusing on technology, TSLY seeks to capitalize on the rapid pace of technological innovation and the resulting growth opportunities presented by companies within the sector. 2. Innovation and disruption. Technology is synonymous with innovation and disruption, making it an attractive sector for investors seeking exposure to companies with transformative capabilities. TSLY recognizes the disruptive nature of technology and allocates its investments to companies that are leading the charge in developing innovative products, services, and solutions. This focus on innovation allows TSLY to capture the upside potential of companies at the forefront of technological advancements. 3. Diversification. While TSLY's primary focus is on the technology sector, it also maintains a degree of diversification within its portfolio. This diversification may include exposure to subsectors within technology, such as software, hardware, and telecommunications, as well as allocations to other sectors, such as consumer discretionary and healthcare. By diversifying across sectors, TSLY seeks to mitigate sector-specific risks and enhance the resilience of its portfolio. 4. Market leadership. Another factor driving TSLY's sectoral allocation is the market leadership exhibited by companies within the technology sector. Technology giants such as Apple, Microsoft, Amazon, and Alphabet, Google, command significant market share and influence within their respective industries. TSLY allocates its investments to these market leaders, recognizing their dominant positions and potential for sustained growth and market outperformance. 5. Risk management. TSLY's sectoral allocation is also guided by considerations of risk management. While technology offers attractive growth prospects, it is not immune to volatility and market fluctuations. TSLY carefully assesses the risk-return profile of each sector and adjusts its allocation accordingly to manage risk exposure and enhance portfolio stability. Understanding TSLY's sectoral allocation has significant implications for investors seeking exposure to the technology sector. By allocating investments to sectors with high growth potential, innovation, market leadership, and effective risk management, TSLY aims to deliver long-term value to investors. However, investors should also be mindful of the inherent risks associated with sector-specific investing, including volatility, regulatory changes, and competitive pressures. The sectoral allocation strategies of the TSLY ETF reflect a deliberate and strategic approach to capturing the growth potential of the technology sector while managing associated risks. By focusing on sectors with high growth potential, innovation, market leadership, and effective risk management, TSLY seeks to construct a portfolio that delivers attractive returns to investors over the long term. As investors evaluate their investment options, understanding TSLY's sectoral allocation can serve as a valuable guide for portfolio construction and asset allocation decisions. Question 4. What are the key differences between TSLY and other ETFs with a similar investment focus? Before delving into the differences between TSLY and its peers, it is essential to understand their common ground. TSLY, along with other ETFs focused on the technology sector, shares a common investment objective: to provide investors with exposure to technology-related companies. However, beyond this overarching theme, differences emerge in areas such as portfolio composition, investment strategy, expense structure, and performance metrics. Key differences. 1. Index tracking methodology. TSLY tracks the Technology Select Sector Index, which includes companies from various technology-related industries such as software, hardware, telecommunications, and semiconductors. Comparable ETFs may track different indices, each with its unique methodology and criteria for selecting constituent companies. For example, some ETFs may track broader technology indices that include companies from adjacent sectors such as consumer electronics or e-commerce. 2. Portfolio composition. TSLY's portfolio composition is primarily focused on large-cap technology companies, including industry leaders such as Apple, Microsoft, Amazon, and Alphabet, Google. Comparable ETFs may have different portfolio compositions, including a mix of large-cap, mid-cap, and small-cap companies, or a more concentrated focus on specific subsectors within the technology industry. 3. Sectoral allocation. TSLY's sectoral allocation is predominantly concentrated in the technology sector, reflecting its investment thesis and objectives. Comparable ETFs may have different sectoral allocations, with varying degrees of exposure to technology and other sectors such as healthcare, consumer discretionary, or industrials. 4. Expense ratio. TSLY has a specific expense ratio that investors incur for managing the fund, covering operational expenses, management fees, and other costs. Comparable ETFs may have different expense ratios, which can impact overall returns for investors. Lower expense ratios may be more attractive for cost-conscious investors, especially over the long term. 5. Performance metrics. TSLY's performance metrics, such as historical returns, volatility, and risk-adjusted performance, may differ from those of comparable ETFs. Factors such as portfolio composition, sectoral allocation, and index tracking methodology can influence performance metrics and outcomes for investors. 6. Diversification and risk management. TSLY employs diversification and risk management strategies to mitigate portfolio risk and enhance stability. Comparable ETFs may have different approaches to diversification and risk management, depending on their investment philosophy and objectives. While TSLY and comparable ETFs share a common investment focus on the technology sector, they exhibit key differences in areas such as index tracking methodology, portfolio composition, sectoral allocation, expense structure, performance metrics, and risk management strategies. Whether seeking broad exposure to the technology sector or a more specialized focus, investors can leverage these insights to navigate the ETF landscape and construct a portfolio that meets their needs and objectives. Question 5. How does TSLY adapt its investment strategy to changing market dynamics and technological trends? TSLY's investment strategy is rooted in its mission to provide investors with exposure to the transformative power of technology. Central to this strategy is a commitment to staying abreast of changing market dynamics and technological trends, allowing the fund to position itself strategically and capture value for investors. TSLY's adaptive strategy encompasses several key elements. 1. Continuous monitoring. TSLY employs a rigorous process of continuous monitoring to assess market developments, macroeconomic trends, regulatory changes, and technological advancements. By staying vigilant, TSLY can identify emerging opportunities and risks in a timely manner, enabling informed decision-making. 2. Flexibility and agility. TSLY maintains flexibility and agility in its investment approach, allowing it to adjust its portfolio positioning in response to changing market conditions. This flexibility may involve reallocating investments across sectors, adjusting sectoral weights, or rebalancing the portfolio to capitalize on emerging trends or mitigate risks. 3. Dynamic asset allocation. TSLY employs dynamic asset allocation strategies to optimize risk-adjusted returns in different market environments. This may include adjusting the allocation between equities and cash, incorporating derivatives for hedging purposes, or rotating investments across sectors based on relative valuation and growth prospects. 4. Thematic investing. TSLY engages in thematic investing, identifying and capitalizing on overarching trends and themes within the technology sector. This may involve targeting specific subsectors or themes, such as cloud computing, artificial intelligence, cybersecurity, or digital transformation, to capitalize on long-term growth opportunities. 5. Active management. TSLY's active management approach allows it to take advantage of market inefficiencies, mispricings, and valuation discrepancies within the technology sector. Through bottom-up fundamental analysis and rigorous due diligence, TSLY identifies high-conviction investment opportunities and actively manages its portfolio to enhance returns and manage risks. 6. Risk management. TSLY prioritizes risk management and capital preservation, employing robust risk management practices to protect investor capital during periods of market volatility or uncertainty. This may include implementing risk controls, diversifying across sectors and asset classes, and employing hedging strategies to mitigate downside risk. TSLY's adaptive investment strategy has significant implications for investors seeking exposure to the technology sector. By dynamically adjusting its portfolio positioning in response to changing market dynamics and technological trends, TSLY aims to deliver attractive risk-adjusted returns over the long term. However, investors should be mindful of the inherent risks associated with active management, including the potential for underperformance during certain market environments or periods of volatility. TSLY's adaptive investment strategy exemplifies its commitment to navigating changing market dynamics and technological trends to deliver value to investors. By maintaining flexibility, agility, and a proactive approach to portfolio management, TSLY seeks to capitalize on emerging opportunities and mitigate risks in the ever-evolving technology sector. As investors evaluate their options, understanding TSLY's adaptive strategy can serve as a valuable guide for portfolio construction and asset allocation decisions in an increasingly dynamic and complex investment landscape. Question 6. How does TSLY assess the growth potential of its portfolio companies, and what metrics are used for evaluation? TSLY's assessment of growth potential is a multifaceted process that combines quantitative analysis, qualitative insights, and strategic considerations. At its core, TSLY seeks to identify companies with the ability to generate sustainable revenue and earnings growth over the long term, driven by factors such as market demand, competitive positioning, innovation, and industry dynamics. Key metrics for evaluation. 1. Revenue growth rate. TSLY evaluates the historical and projected revenue growth rates of portfolio companies to assess their top-line growth potential. Companies with consistently high revenue growth rates or strong growth prospects may be favored for inclusion in the portfolio. 2. Earnings growth rate. In addition to revenue growth, TSLY considers the earnings growth rate of portfolio companies as a key indicator of profitability and operational efficiency. Companies that demonstrate strong earnings growth potential may be viewed favorably by TSLY's investment team. 3. Return on equity, ROE. TSLY analyzes the return on equity of portfolio companies to assess their ability to generate returns for shareholders. Companies with high and improving ROE may indicate efficient capital allocation and strong growth potential. 4. Profit margins. TSLY evaluates the profit margins of portfolio companies, including gross margins, operating margins, and net margins. Companies with expanding profit margins may indicate pricing power, cost efficiencies, and scalability, contributing to their growth potential. 5. Free cash flow, FCF, generation. TSLY assesses the ability of portfolio companies to generate free cash flow, which represents cash generated from operations after accounting for capital expenditures. Companies with strong free cash flow generation may have the flexibility to reinvest in growth initiatives, pursue strategic acquisitions, or return capital to shareholders. 6. Market share and competitive positioning. TSLY considers the market share and competitive positioning of portfolio companies within their respective industries. Companies that dominate their markets or exhibit strong competitive advantages may have greater growth potential due to their ability to capture market share and sustain pricing power. 7. Innovation and research and development, R&D, investment. TSLY evaluates the level of innovation and investment in research and development, R&D, of portfolio companies. Companies that invest in innovation and develop cutting-edge products or services may have a competitive edge and long-term growth potential. 8. Total addressable market, TAM, size. TSLY assesses the total addressable market size of portfolio companies' products or services to gauge their growth opportunities. Companies operating in large and growing markets may have significant expansion potential and attractive growth prospects. In addition to quantitative metrics, TSLY considers qualitative factors and strategic considerations when assessing the growth potential of its portfolio companies. These may include management quality and execution. TSLY evaluates the quality of management teams and their track record of execution in driving growth initiatives, managing risks, and creating shareholder value. Industry dynamics and trends. TSLY analyzes industry dynamics, competitive landscapes, and emerging trends to identify companies well-positioned to capitalize on growth opportunities and navigate industry disruptions. Business model resilience. TSLY assesses the resilience of portfolio companies' business models to withstand market volatility, regulatory changes, technological disruptions, and competitive pressures. Corporate governance and ESG considerations. TSLY considers corporate governance practices and environmental, social, and governance, ESG, factors when evaluating the growth potential of portfolio companies, recognizing the importance of responsible and sustainable business practices. TSLY employs a comprehensive methodology for assessing the growth potential of its portfolio companies, encompassing quantitative metrics, qualitative factors, and strategic considerations. By evaluating factors such as revenue and earnings growth rates, return on equity, profit margins, free cash flow generation, market share, competitive positioning, innovation, and industry dynamics. TSLY aims to identify companies with the ability to generate sustainable long-term growth and deliver value to investors. As investors navigate the dynamic landscape of ETF investing, understanding TSLY's approach to assessing growth potential can serve as a valuable guide for informed decision-making and portfolio construction. Question 7. What is the rationale for investing in TSLY at this time? What are the expected returns and risks? In the ever-evolving landscape of investment opportunities, the Technology Select Sector SPDR Fund, TSLY ETF, emerges as a compelling choice for investors seeking exposure to the dynamic and innovative technology sector. As investors contemplate their investment decisions, it is essential to assess the rationale for investing in TSLY at this time, considering factors such as market dynamics, technological trends, expected returns, and associated risks. In this comprehensive analysis, we explore the rationale for investing in TSLY ETF, examining the potential returns, risks, and strategic considerations that underpin its appeal to investors. Rationale for investing in TSLY. 1. Exposure to technology sector growth. One of the primary rationales for investing in TSLY is its exposure to the robust growth potential of the technology sector. The technology sector continues to drive innovation, disrupt traditional industries, and reshape the way we live, work, and communicate. TSLY offers investors the opportunity to capitalize on this growth trajectory by investing in leading technology companies at the forefront of innovation. 2. Diversification benefits. TSLY provides investors with diversification benefits by offering exposure to a broad range of technology-related industries, including software, hardware, semiconductors, telecommunications, and Internet services. Diversification helps mitigate single-stock risk and sector-specific volatility, enhancing portfolio stability and risk-adjusted returns. 3. Market leadership and innovation. TSLY's portfolio comprises market-leading companies that drive innovation and shape the future of technology. These companies, including industry giants such as Apple, Microsoft, Amazon, and Alphabet, Google, possess strong competitive advantages, robust business models, and the financial strength to navigate market uncertainties and capitalize on growth opportunities. 4. Long-term growth potential. TSLY offers exposure to companies with significant long-term growth potential, fueled by secular trends such as cloud computing, artificial intelligence, e-commerce, digital transformation, and the Internet of Things, IoT. These trends are expected to drive demand for technology products and services across industries, creating opportunities for sustained revenue and earnings growth. 5. Portfolio management expertise. TSLY benefits from the expertise of seasoned portfolio managers and investment professionals who employ a disciplined investment approach to identify attractive investment opportunities within the technology sector. TSLY's active management strategy allows it to capitalize on market inefficiencies, mispricings, and valuation discrepancies, potentially enhancing returns for investors. Expected returns and risks. 1. Expected returns. While past performance is not indicative of future results, historical data suggests that the technology sector has outperformed broader market indices over the long term. TSLY aims to capture this outperformance by investing in companies with strong growth prospects and competitive advantages. However, it is essential to note that returns are subject to market fluctuations, economic conditions, and company-specific factors. 2. Risks. Investing in TSLY entails certain risks that investors should consider. These risks include Market risk. TSLY is exposed to market risk, including fluctuations in stock prices, interest rates, and macroeconomic factors that can impact overall portfolio performance. Sector concentration risk. TSLY's focus on the technology sector exposes it to sector-specific risks, such as regulatory changes, competition, technological obsolescence, and market sentiment. Company-specific risk. Individual companies within TSLY's portfolio may face company-specific risks, including management changes, product recalls, litigation, and cybersecurity threats. Volatility risk. TSLY may experience periods of heightened volatility, particularly during market downturns or periods of uncertainty, which can impact portfolio returns and investor sentiment. Currency risk. TSLY's investments may be denominated in foreign currencies, exposing it to currency exchange rate fluctuations that can affect the value of its holdings. Investing in TSLY ETF offers investors exposure to the growth potential of the technology sector, diversification benefits, market leadership, innovation, long-term growth prospects, and portfolio management expertise. However, investors should carefully consider the expected returns and associated risks before making investment decisions. In conclusion, TSLY ETF offers investors exposure to the dynamic technology sector, leveraging a robust investment thesis, meticulous selection criteria, and strategic sectoral allocation. While it presents promising growth potential, it's crucial to weigh the expected returns against the associated risks before diving in. Whether TSLY is the right investment for you depends on your investment objectives, risk tolerance, and time horizon. Remember to do your due diligence and consult with financial professionals before making any investment decisions. Thank you for watching, and happy investing!